Welcome to Taxed and Confused, the podcast where tax administration meets real talk. We are your hosts, Lizzie and Lisa, two tax nerds on a mission to decode the rules, demystify the system, and maybe even make you laugh along the way. From tax returns to objections and everything in between, we're diving into the world where the burden of proof is on you, not the ATO. That's right, this isn't criminal law. In tax, you're guilty until proven compliant. But just a quick heads up, this podcast is for educational purposes only. It's not tax advice, and it's definitely not a substitute for professional guidance tailored to your situation. So brace for bureaucracy and join us as we explore the weird and the wonky and the wildly important world of tax admin, because when it comes to tax, we are all a little taxed and confused. So in this guidance edition, we are delving into a recent draft tax ruling dealing with rental properties that reflects perhaps a shift in the ATO's interpretation of a leisure facility and what constitutes mainly used. We are focusing here on those rental properties that are not deriving income from carrying on a business. Think more about the holiday home at the beach you might rent out. So this is looking a little bit more at the application of some of the ATO guidance and advice that is on offer for taxpayers in assisting their compliance obligations, which follows on from a prior episode. So starting off, Lisa, for context, can you briefly outline the state of play around rental property income not derived from carrying on a business? So just before we jump into the tax ruling itself, just for the listeners who may not be on top of the general state of play of taxing rental property income.
Oh, we're talking about my favourite provision at all in the whole world, as you well know, Lizzie. It's my favourite one, 8-1, the old Section 51, which is our general deductions provision. So we're basically saying if you're not in business, you've got to be earning assessable income to be able to claim a deduction. Okay, so that's what we're talking about. And that's the positive limb, as we call it. So we're saying we've got to earn assessable income first because you're not running a business. So therefore, we've got a renter in, or you're leasing some property, or you're getting some sort of income, from someone using your car garage or whatever. And then we've got our negative limbs of that provision that says, but if it's capital, we're going to kick it out, right? If it's private or domestic, we're going to kick it out. Or if there's a denied deduction, we're going to kick it out, right? That's sort of where it comes down to. Okay, so we're just basically saying you've got to have assessable income, but we'll kick it out under other grounds. So holistically, what we're talking about with rental properties, and it's popular, isn't it? Negative gearing, everyone knows about, everyone's talked about it, right? So we can claim deductions for renting rental properties out, whether it's commercial or residential. There's a few different nuances as well, but we're saying that you can claim a deduction for your ongoing costs, and then you can claim a deduction for the yearly sort of costs associated with it. So the common deductions are any of the utilities, your rates, your water rates, your property management fees, because if you're passively doing it, you've probably got a property manager for it. The big one that makes it negative gearing is this interest deduction as well. Okay, you've got your insurance. What other things have we got, Lizzie? We've probably covered most of it. Your repairs and maintenance and those sort of things as well. But most of the deductions to do with rental properties is under this general deduction. And you just mentioned rental repairs and maintenance. Well, that's a specific deduction, right? So we've got a specific deduction for it. So the way our tax rules work is go to general, but if there's a specific deduction that covers it, you've got to pick the one that best suits. So if it's a repair, it's not a general deduction, it's a specific deduction under rentals. And then we've got any deductions that are denied. So when we tell the ATO I've got a rental property, we've got how many weeks in the year was it available for rent, okay? And we then apportion things that way, because 8-1's got this beautiful thing, to the extent that. So we're saying that if you're not earning assessable income, you need to apportion it. Okay, so if you've got, let's think of a yearly expense like insurance. if you only rent the property out or have it available for rent, remember it's not renting it, it's available for rent is the way the terminology used. If you only rent it out for half a year, you can only claim a deduction for half the insurance costs, right? The one that's linked to, and it doesn't have to be rented, but you've got to advertise and all that sort of stuff. That's what we're saying with that word available to rent. And that's roughly how it works. You apportion things for a year, but if you've got a repair and maintenance, you've got to fix a tap, a leak or whatever, you just claim that. Your property management fees you claim as you go as well. So that's sort of your gardening or whatever else you can claim, right? So that's sort of how it happens. And rental properties are always on the ATO radar and under ATO scrutiny because with interest rates high, it's likely, I won't say all the time, but likely that you're probably making a loss on a yearly basis on that renting that rental property. And why do people want to do that? Because that loss can be offset against other assessable income, normally salary and wages.
Yeah, and which is controversial. We often see that in the media around the political cycle, the election cycle about, tax reform and things like that. So it is a big area. And a lot of errors often come to fruition because of that to the extent. So the lack of apportionment, assigning what is deductible and related to the income earning activities versus more private and domestic usage side of things, or even the interest if you've used that loan to buy the car or cover off some personal purchases or travel or things like that. It muddies the water of what that loan is about, and so that apportionment is needed so that you're only claiming interest on the loan that relates to that rental property. So a lot of challenges in getting that right. So we'll now take a jump into the tax ruling here. So we obviously have tax rulings that the ATO produced to provide guidance to taxpayers, and we have a tax ruling here for rental properties. It's in a draft form though. It's TR 2025-D1 at the moment. We'll put a link in the show notes to that, but we're going to be talking about that particular tax ruling. So, Lisa, did you want to start us off? What are we looking at here with this tax ruling? What is it seeking to do?
Well, there's a lot of information in this ruling because they haven't produced one for a while. So this is a tax ruling that is bound by the ATO, so we can rely on it, which is lovely. And you talked a little bit before about the apportionment bit. This tax ruling goes into a lot more detail about how you apportion it and how you substantiate the apportionment, which is great. That happens for everyone. Okay? But what it's coming to, it's talking about a denied deduction. And what this is really focusing on is this new denied deduction, which is 2650. Right? And it says we're going to deny deductions if it's considered a leisure facility. Okay? And you go, leisure facility? What is a leisure facility? Okay? Now, I only know that this provision exists, Lizzie, actually, is because the provision before that is about charter boat operating. And when I was with a Big Four firm, they said deductions are denied for if you're chartering a boat. Now think about it. What sort of people have a charter boat? Rich people, right? So, if you've got a boat in the Caribbean and you go and use that boat, and every now and then you've got a captain and a cook and all that sort of stuff, you'll rent it out to your latest celebrity and things like that. That's always been a little bit of a grey area for the ATO. So we're basically saying there's a specific deduction. But this one is whether there's a leisure facility, we're going to deny deductions for this. Now, the interesting part of it is this is a specific denied deduction. So as I talked about earlier about the apportionment and general deductions and things like that, and it being on the ATO radar, there was another denied deduction that came through in legislation a little while ago, and it basically said this, that you can't claim any travel expenses to residential properties, residential investment properties. Okay, you can claim your travel to go and visit your tax agent. You can claim your travel to go and see your financial planner and those things. But if you've got a rental property and you need to replace a washer, so you go to Bunnings and you come back and you replace the washer because it's going to cost you $5 to do it instead of a $300 call-out fee to the plumber, you can't claim your mileage to go to Bunnings and back, right? So that's what they did. And you go, well, that doesn't seem fair, does it, Lizzie? You know, that's sort of what we're talking about. But the reason they did that is because us Victorians always have investment properties in Queensland. And so we were claiming our airfares up for having a holiday to check on the property, even if we didn't stay in it. So this is where it was closing up loopholes. Now, this 2650 that's in this tax ruling has always been there. That it's not a new provision, but the ATO, they haven't publicly expressed their view on it, is what they said in this ruling. So it says the ATO acknowledges that it has not previously publicly expressed the view that such deduction incurred by non-business individuals would be denied on the basis of the property. The property is properly characterised as being mainly a holiday home used for recreational purposes and therefore considered a leisure facility under 2650.
So this tax ruling is really bringing this new position, newly expressed position that the ATO now has of how it's going to characterise these properties, which will really shift the landscape, therefore, in how you can claim deductions in relation to that rental property that you are earning income for. So this is a real shift in interpretation, isn't it? This has not been a position that the ATO has expressly held. But it's only in draft form. So before we go into the nitty-gritty of it, it is a tax ruling that is in draft form at this stage. So it's not finalised. We're not quite sure when it's going to be finalised.
No, so what the ATO do consultations, and sometimes the consultations give you lots of time. Sometimes the consultations give you not very much time. And the three accounting bodies usually put in a submission, the Tax Institute as well, put in a submission, sometimes a joint submission for resourcing, but they say, this is what we like, this is what we don't like. Okay, so this tax ruling's open to consultation. Now, what they sometimes do is they release one just before Christmas and they only give us until just after Christmas to consult on it. We won't go into the politics of that, but, you know, we need enough time for good consultation to make good laws. But when you look at these, can I say, this is not really that controversial. Like, it's not going to get the politicians excited because they're not going to lose votes on it. It's probably going to go through with very, very few minor amendments. Now, the submissions that they're looking for under consultation is usually making sure that it's workable more than anything else. Most of the time we go, we know that's in legislation, we can't pull it out. What you're saying is pretty right, ATO, but let's just clarify it more and make it workable for everyone. Because remember, these tax rulings should be for certainty. If the ATO have to rely on it, we have to be able to apply it, which means we want certainty of it.
But what about the fact that if this is a new perspective that they are imposing, we've got this tax ruling that is coming out now, what about the fact that taxpayers would have, or tax practitioners even, would have had a different perspective of whether this denying provision would have applied? So all the years prior would have not treated it as a leisure facility, so would not have excluded deductions. So have they got their tax return wrong in the eyes of the ATO now, or is this, how do we deal with the tax ruling here?
Yeah, that's a great question, Lizzie, because what happens is...
It's a bit of a loaded question.
Yeah, no, it's a loaded question. You know the answer to it. But, like, it's from the date of the ruling, and it's usually from the date of the draft. And as we know, there's very rare retrospective in any of our laws, let alone our tax laws. So they're saying you're grandfathered, in other words. It's a word that hasn't actually to be degendered, but we still call it grandfathering. So it's the previous ones, we're all good, as you know, right? And then we're saying, well, from the date of this draft ruling, we're going to apply it from a specific income year. Even when you look at it from an administrative point of view, when new laws come in, most of the laws now say it will apply from the income year after it receives royal assent. right? So the year it's in, royal assent, it'll be the next income year it'll
Which is
apply to.
important because a lot of these things can take quite a long time to actually become law and enacted. And we've had a lot of instances in the tax space where there are set dates specified, and often the law hasn't even been enacted, receive royal assent, really in time to
Well, we even
actually
look at
make
instant
use of
asset
that.
write-off, Lizzie. We get
Mm.
annoyed with instant asset write-off. That's the $20,000, everyone. We're basically always in the income year where we can write it off before it's actually become LAW law, because it's one of those things where the current government just wants to perpetually go, yay, we've extended it for another year, give us a pat on the back, give us votes, right? So, I mean, that's how it works. So with, as you said, so with this draft ruling, it's sort of saying we're signaling, ATO saying we're signaling it from this date, we're going to apply for future. So your question was, has previous returns been done incorrectly? You could say yes, but you're not going to get audited for them.
No. And it also comes down to, in our prior episode when we talked about LAW versus LORE. So remember, this is guidance that the ATO is producing. This is a ruling that the ATO is producing that the commissioner is going to be bound by. And it's a compliant risk issue. The law itself has not changed here. So we're still applying the principles of Section 8.1, which is our main general deduction provision. We've got our legislation that lists our specific provisions, like the specifically denying provision of the leisure facility. So none of that has changed. This is the ATO's interpretation being expressed in a novel way in this space, and therefore the compliance resources that they then are going to take forward in this space, because it is a genuine issue of incorrect claims of deductions being perhaps over exaggerated through not apportioning private usage, etc. So there's genuine risks here. There's genuine gaps in perhaps what taxpayers ought to do. I'm not suggesting that there's data specific to that here, but there's just a general area of this being a topic in the ATO's radar that taxpayers perhaps aren't getting quite right, and essentially this is really tightening in the interpretation here.
Exactly. And that's what we need to go back to, because you sort of sent me down a very good path of going, well, what previously happened? So what would previously happen in these situations that are getting targeted by saying this is what a leisure facility is? So you've got a holiday home down on the beach or at a ski field or whatever, okay? And you rent it out through the year. It's not your main residence or anything like that. So you might go and use that facility, which you're allowed to do, okay? You're going to use that property, Christmas, Easter, school holidays or whatever. What's that going to add up to? A month, 2 months for the year. So when you then prepared, what previously happened is when you prepared your rental property schedule and your tax return, you would have said, how many weeks was it available for rent? You'd go, 48, 44 or whatever, and you'd apportion it the yearly costs. Okay, so your rates, your insurance, your interest, and those sort of things, you're apportionate for it. Okay, because that's what 8-1 says. Agree? You apportion to the extent. That's what we do. Right. So we're saying we're still going to claim some, but not going to claim all. Right? Because we're apportioning to the extent you're earning assessable income. But then you look at the interpretation of this little chestnut of a denied deduction. It says mainly used as a leisure facility. Now, when I look at that one, I go, well, the interpretation of mainly, if we're talking about, say, PSI, another thing, we go mainly's more than 50%, right? So then you go back and say, well, I don't think I'm covered by this provision prior to this tax ruling, because I'm going, mainly's more than 50%. I've only used it for a couple of months. Therefore, I can still apportion it. But this is what the kicker is with this ruling that's changed the game and said this is how we're interpreting it. They're saying if it's a leisure facility and you're using it at peak time, so as I said, Christmas, Easter, school holidays, we're saying that you cannot claim those yearly costs at all. not even apportioning them.
Yeah,
So
yeah.
everyone's jaws dropped and gone, oh, is that what it means? So this is the ATO's interpretation. Now, we haven't seen the submissions for this draft yet, but I'm thinking that would be my argument if I was putting it in the draft. I'm going mainly should be more than 50%, not just at peak holiday time.
Yeah, and we need to look at the interpretation of mainly in other comparable areas, but obviously it comes down to the interpretation of mainly within this particular provision. So the ATO has expressed a particular interpretation that narrows down essentially to those peak times. And so if it's mainly used for a holiday home for your own family during those peak times, then that's really going to trigger that specifically denying provision and therefore deny those deductions. So quite a different outcome to, as I said, as we were talking earlier, to the extent being an apportionment on essentially a number of days of the whole year. So I think this is going to take a little bit more time to unpack as we see the consultation on see what the submissions are through the consultation process, whether this draft ruling, how it then is edited, to what extent, if any, when it becomes the formal final version. But ultimately, it still could be challenged through the normal appeals process. We still ultimately could see cases going through the courts that then either support the ATO position or revert to the pre-expressed position here. So I think it's going to be quite fascinating to see how this plays out and whether we do see challenges in this space. But it certainly is a tightening of interpretation here of that word mainly, and therefore bringing this a lot more kind of unknown provision into the spotlight here, because rental properties are very they're quite dispersed. There's a lot of taxpayers that do hold these properties, and so there's quite a broader taxpayer base that will be impacted here.
It's quite interesting to actually wonder why this has triggered the ATO radar in this case. Because if you think about it, if it's an investment property, your main purpose should be to generate assessable income from it, Lizzie. Would that be a fair assessment, do you think? I would say you're trying to do that. So, but if you want to use it for holiday purposes, is that then a holiday home? So it's that you're trying to get into the psyche of what you're doing. I've got a client where he's got a huge home in Bright near the ski fields of northeast Victoria, and that property can have 28 people staying there, and he Airbnbs and Bs it, right? He's got a brother up there, and so I say, well, do you go up there and use it? He says, no, I stay with my brother. That's purely for an investment vehicle. And that's what I think they're trying to get at with the ATO. This dual purpose thing, we're going, I think you're taking you're taking advantage. And that's where I sort of alluded to with that denying of travel.
Yeah,
for residential. I think that
example
came in the same. I just sort of thought that brought the analogy in that if you're trying to take advantage of the tax system in this way, when it's private.
Yeah. And I think it's that I think like travel for work purposes is another good example. If you're going to a conference interstate, so if you're traveling from Melbourne to Sydney for a conference and that's your sole purpose, it's a work conference, you're going there, you're going to claim airfares, you're going to claim accommodation, the conference registration. But as soon as we have a continuum of private usage, if we look to one extreme to the other, if you've actually gone to Sydney and it's your holiday, you've gone to Sydney for a holiday, but while you're there, you're like, oh, there's a conference that's relevant to work, I might attend that. You all of a sudden move to a position where you were potentially claiming flights, accommodation, registration. In that instance, it's a holiday to Sydney, but you're attending the conference there, so you're not going to claim flights, you're not going to claim accommodation, but you would claim the registration fee. So there's that middle ground there. That's that. Well, where does it become one extreme to the other when there's a bit more of a dual purpose or an equal purpose? You're entering into that grey area, and it's hard. It's not a black and white answer there, and there's got to be a line in the sand. So here you can see that the ATO is expressing a line in the sand that perhaps was perceived or hadn't really been thought about, but perhaps a little bit more towards that kind of analogy too.
Yeah, exactly. And in a focus area that's really been under the on the radar for the ATO forever is rental properties, because they always do reports on, corrections to the schedule and all those sort of things.
Yeah. So I think with the growth in Airbnbs and all those kind of sharing facilities, it's a particularly growing area, and there's data on this. There's data here. So they have access to a lot of data. So there's probably a lot of work going on in behind the scenes interpreting what's going on here, and red flags being raised. And not that I'm certain of that, but I feel that there's certainly that access to data is probably leading to some questions there to be answered.
And that's exactly right, Lizzie, because when I look at it, as I said, intention is so important with a lot of what we do in tax. What was your intention? And remember, as you say in our introduction, the burden of proof is on us. So the question now becomes, what was your intention when you purchased the property? What was the intention when you did the transaction? What was the intention when you went on your business trip? Did you book the holiday first and then book the conference, or the other way around, right? So what I'm saying here is, give me contemporaneous documentation, do file notes. These are the kind of things that support, and they get beautifully supported by judges in case law and things like that. That if you've got contemporaneous documentation, the judge will just say, you're a good taxpayer. You're excellent. I can believe you. This all fits with what you're doing. That's what you're looking at. But you've got to have the intention. The same thing when you move into your main residence. Is your intention for this to be my forever home? I say to my clients all the time, send me an email and say, this is going to be my forever home. And then if they change their mind and sell it in a year, it means it still can be on capital account. You know what I mean? They haven't flipped it and made it on revenue account. But I go, just send me an email, because at least then it's contemporaneous. Because I love sending emails for the very reason it's time stamped. You've got all the metadata and things like that. That can't be massaged.
Or look at passenger incoming cards. If that conference is overseas, what did you actually put on that? Did you put for the reason of travel to go on a holiday, or did you put it for conference or a work purpose? They all add up to the jigsaw puzzle to reflect and evidence, and that's so important in the tax space.
Well, it's even, I've got a client, we're talking about travel and things like that. I've got a client that does surf magazines. And the previous accountant wouldn't let his flights to Hawaii go in there because it's a holiday. And I go, no, you're going there to talk to photographers, get articles written and all those sort of things. Yeah, it is a holiday destination for some, but what's your intention for going there? For business, right? Yeah. And that's the other thing, that just because it's deductible for one person doesn't make it deductible for someone else. It's all from our taxpayers' point of view.
Yeah, that's
probably
it.
Sidetracked a little bit, but it was quite an interesting discussion.
Exactly. Yeah. And I'll kind of probably wrap up on and saying that, remember, this is a tax ruling. This is the interpretation that the ATO holds, but it doesn't mean a taxpayer cannot challenge that. Obviously, they've got to be willing. It comes down to that risk profile, perhaps the circumstances, whether they're in a position to object, to appeal, to take it through the courts, perhaps become a test case if it's a particularly noteworthy issue. These are the positions that the ATO have, and we've got to keep that in mind as distinct from the law that is, the legislation case law. So the ATO are doing a wonderful job to try and administer and rein in a lot of complex affairs. Tax really touches our everyday life, how we operate, what we do, what our interests are, and so there's a lot of blur, there's a lot of grey that they're having to make sense of. So they've got to be able to provide guidance and assistance and provide clarity on these very uncertain, ambiguous situations. And it's always going to get muddy. It's always going to get controversial. It's always going to have a lot of debate about what we should do. And, this is going to be debated until, for example, it goes to court. for the particular issue. And we see that quite regularly. So with that, Lisa, was there any key takeaways that you would like to wrap up on as a final word for this episode?
I think the main thing is that from the date of this ruling is where it's going to apply to this new interpretation. We need to see what the final outcome of this interpretation is, as you said. So it's not like it's all grandfathered previously. And the other thing I'd just like to touch on here is that given the interpretation of this ruling is that if you're there at the main holiday times, it's going to be knocked out by this provision. Remember, the ATO can see all your social media. So if you've got a photo of that rental property on your Insta or whatever, they'll always see it. So remember that all the data is out there in the World Wide Web or whatever you want to call it now. And that's what the ATO can draw on.
Yes, data is critical here and really relates to the onus of proof being on the taxpayer. So with that, that's it for this episode of Taxed and Confused, where the rules are rigid, the paperwork is endless, and the burden of proof is all yours. If you enjoyed today's deep dive into tax admin, don't forget to subscribe, leave a review, and share it with someone who's just as confused as we are. And remember, this podcast is for education, entertainment purposes only. It's not tax advice, and we're not your tax agents. Thanks for listening, and until next time, stay curious, stay compliant, and stay just a little bit taxed and confused.